Yo, 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 everybody. What's going on? axisALiVE and first time ever guest WaLLrus joining me today. How you
What's
doing, bud?
up, brother?
Hey, man. So you reached out to me maybe like 3 or 4 weeks ago, maybe, and we, mentioned that you'd been following for a while, listening to some of my stuff, and obviously I've had my eye on you for a while as well, and appreciate all your, big brain content. It's appreciated. And it's always based. And so today, I think us coming together is going to be a good conversation on a lot of things. General market sentiment. New things coming from LL. I don't know when launch soon. Probably 30, less than 30 days, maybe.
It's right there. So everything on LL's nice, prime, finished. Audits are all completed. Everything's good to go there. We have our draft. We're about to release the full audit that came from Halborn. Again, those guys are awesome. I got to give them a shout out all the time. Not just the quality of the work they did, but just kind of as professionalism. We're glad to have a company that large kind of plugged in with some of the Pulse Chain stuff. So hopefully more projects reach out with them in the future. We're finishing up with Fetch now. So Fetch has been on testnet. LL's been on testnet. All that stuff's rocking well. They're finishing up. Same guys. Halborn is finishing up the audit on Fetch, and after that, we just set the date and rock and roll. So a couple of weeks finish up that audit there, but I know everybody gets so antsy. It feels like we've been here so long, but as we're coming on day 65, something like that. We're right there. I know everything feels soon 2 weeks, but yep, projects, everything is all nice in there. It's beautiful. It's polished. We have a lot more coming after the fact, so we'll have cool stuff coming. Like people don't even really know how cool Fetch is going to be until after.
Yeah, I'm curious about that. Is that like a link analog? Like, is that an Oracle or I guess I'm not really in the know on it.
Yeah, it's a fork of Teller, so it's a decentralized Oracle. Like the quick overview for people that aren't that savvy on the Oracle side, haven't really dug in, is it almost works like a proof of stake network. So you kind of, instead of validators, they're reporters, and reporters are allowed to answer basically any request for a price call. So any project, any smart contract can basically put a request, and then the reporters on the Oracle are what send out that information, right? But they can be challenged. Brian, my man, hey, while you're on stream, brother, thanks so much, man. You've hooked up so many of us. I got my care package. I say I got it.
I wish
it
I had my bucket hat on right
and
now.
My wife stole it, so it does exist. I think I got it here. Yeah, let me bucket hat up real quick.
Dude, I would wear I was thinking about wearing it, but it's hard with the headset.
So Brian, what a legend, man. Thanks for taking care of so many people. He also tried to come through, get our player that was there at the final table. He did end up busting right before we got him. He did get a little screen time. It was right before Brian got them in the gear, all that. But what a legend, man. So definitely appreciate you there, brother. Had to model the bucket hat. Although, yes, Black Hex Skin does do it more justice.
Speaking of her, we'll be there this weekend.
Oh, nice, man. Yeah, she's a legend. She's an absolute blast, man. I've got to meet her a handful of times. We did a stream together. Saw her in Dallas and in Austin and in Vegas. Her husband's amazing as well. So yeah, it's as always, man. The community's incredible here.
Hard worker for sure. Appreciate her so much.
Man, she grinds. So yeah, on the Oracle, essentially it works like proof of stake. Like you have all these reporters, and that's a good one too for anyone that's running validators. I definitely recommend that they come and look at running reporters. Obviously, there's extra yield there. Get to participate again in like how these things run and how they function as a network. So participation is always a big deal. So that's what the Oracle does. Basically, it's what sends that price information or off-chain data. So like the PulseSpot guys, that's how they're going to get like off-chain data so that they can do sports betting. If you say, hey, who won the coin flip, and and you need that information in a contract, it's the Oracle that actually sends that like API data into a smart contract. And then it also was what gives a chance for other reporters to actually vote and dispute a price, right? And that's how you keep that like functionality and
safety. That's what I was going to ask next, was how do you ensure that it's being reported properly?
So there's a couple things here, and you can get kind of down the weed, down that rabbit hole. The part of it is the Oracle is synergistic with how the contract's written. So you can have a really, really good Oracle, and you can still screw it up on the contract side. So the magic on getting it all right is you start with decentralization, having reporters, strong price feeds. The next part is how you basically have that data interact in the contract. So like for LL, we have a delay on those prices, and it's what gives time to make sure that price is actually valid. Otherwise, even if you had a dispute, if the price is already interacting in the contract, you already have the problem, right? So You take good APIs that have a smooth process, you know, a few different ways to kind of smooth out that price. And because you can use this in a variety of ways too. So for something like LL where there's collateral, we don't need to be hypersensitive. We need to be accurate, right? So, you know, tenths, hundredths of a percent, seconds don't really affect the contract, right? They can in some places, but for us they don't. Like if you're high frequency trading, then that matters. You know, that resonance makes a big difference. For us, it's just as long as the price is correct. As long as the price is correct. So you can slow down the feed on the contract side, and then quality APIs, having reporter networks that actually distribute pricing. You kind of have this kind of a scale here of checks and balances.
Okay, cool. Looking forward to all that.
And there's a coin. And now everybody's excited, right? Yeah, there is tokenomics. There is going to be an airdrop. No SAC, no raise. It's a beautiful tool. A lot of projects are going to run it. We're working on a beautiful front end for it. So it's a fork of Teller, and those guys built great foundational tech. The only real downside, in our opinion, was the front end. And so we have not only working on that, although don't worry, it's not going to hold anything up. So we're working on a beautiful front end, and we changed the tokenomics some to make sure that it's more beneficial for the community as a whole, because this thing is coming out early on, and it's going to be one of those things that actually is pretty foundational for a lot of things in Pulse Chain. So it's something that we wanted that community support. We wanted to make sure that they felt valued, that they can contribute and vote and do all these things. So it's important. We made some tweaks that we're very happy about as well.
Is that public yet, or the tokenomics?
They will be here really shortly. We wanted to finalize everything with LL. We just kind of, again, I know everybody wants win. We're always going to be a little slower. We're hyper conservative on these things. So we release things in stages. We try to make sure that everything's nice and finalized on those. So
yeah, that all sounds really good.
Yep. Yeah. So we'll have the full audit report from LL will be released next week or so. As soon as CC has it all together, once he'll want to do another video where he reads through it. Again, we kind of have our own rhyme and reason. So we'll release that full audit report and then drop the, we have a really cool explainer video like the one on LL that everyone loves, that 4-minute video that runs through it. We loved it. So we went and did another one for Fetch that'll explain this stuff, give everybody a quick overview and some framing. And then from there, we'll have the tokenomics dropped probably about that same time. So all that'll be out in the next 2 weeks, right? But actually within 2 weeks here. And again, we'll set a launch date after that as well. And we'll be out here pretty quick.
Great. Well, the timing couldn't be better, because what I'm seeing in terms of the technicals is that, you know, the liquidity on Pulse Chain is pretty baselined and actually increasing now after, you know, how many days you said? 65-ish days after launch. So,
Like that.
You know, the prices are starting to, like, you know, gain and go sideways, which is a positive sign. You know, we'll take a dive into that in a little bit, but I think what first we wanted to do was like zoom out and just kind of talk a little bit about and show some data on a couple things. One being like that resolution on the XRP case and what that could mean in terms of sentiment moving forward for crypto. I know it was something that I had talked about in a blog post going back maybe over a month ago now. How what's going to be that catalyst that really ignites that next phase of the bull market for crypto. And, you know, it wasn't until just recently that, you know, half of crypto even figured out that we were in a bull market, which has been kind of interesting to see. But that's usually how it goes, is people flip bullish toward the middle section of the market cycle, which, you know, potentially could set us up for a shorter run here, leading into like next year, and then potentially like a different outcomes in terms of what we'd expect from the 4-year cycle moving forward. So yeah, I wondered if you had any thoughts on that and directly to the XRP thing. Or
Yeah, I definitely want to touch on the XRP. It seems like almost everyone, for a different reason or another, seems to think the bull's coming sooner. You know, for myself, you know, again, I'm sure it's something that'll be kind of a theme we'll touch on in a few ways, is like markets tend to get sharper, right? So like if you look at you know, anything that comes out from the Fed, they're looking at, you know, any of these other price indexes, like they don't say, hey, we're pretty sure. They're 72% roughly baked in. Like they have this stuff down to where they're quoting like single-digit percentage differences. Doesn't mean they're always right, but that's the level of baked in assumption that they have on that market and its impact on the market. That gets sharper and sharper and sharper. So you add a couple more cycles, you add some institutional value, like crypto is going to get sharper. Like the margins on a lot of things are going to keep getting tighter and tighter. And that comes from accuracy and maturity. So I think that things like the Bitcoin halving, everyone in the world has some take, whether it's right, wrong, indifferent, their variation of it. They think the Bitcoin halving has some impact on bull. And the better people get, the more that impacts, the more sure they are, they start to price that in earlier, right? And it's what you're getting at here. People are late on the middle. So that's one for me, is I think that things get sharper, then they get tighter, right? If everybody starts to figure it out in January, that means the smart guys bought in December, and it means they sell a month early also. I think we'll see a wave of people who kind of again, this is kind of common sentiment, but you get bit last time, you sell out sooner, you start to take profit. So I think that we'll see a different shape in general, kind of to the bull market as a whole. But it seems like for one reason or another, everyone assumes that we're going to see this thing come a little sooner.
Yeah, man. Good point on the market efficiencies getting worked out. And, with that, just something that came to mind was how the stock market indices have just done crazy this year, just overperformed like crazy in the face of all that adversity and tightening that's going on. And I think that crypto did well, but that generally outside of Bitcoin, it actually has been kind of like a lame cycle so far for altcoins. And I'm wondering, like, what does that look like? And maybe this XRP thing is where a lot of the liquidity will come from, because once XRP really gets moving, a lot of that money will get flushed and into other projects, other assets, and it's really the only thing that's driving altcoin dominance against something like Bitcoin right now. Ethereum has been trapped between 1,500 and 2,000 for over 6 months. And you got to wonder, like, what's going to be the straw that breaks the camel's back? Like, what's going to be the thing that's going to push us over? What narrative? What's it going to, where's that next wave of interest going to come from for the Pulse chain ecosystem? Even, like, that's a big question on everyone's mind. But a lot of times, like, this is the start, and we saw like a decent reaction in the XRP price. Actually, personally traded that and on a little bit of leverage, and that was exciting. I didn't have to put a big bet in with enough leverage to see like a huge return. And it's something that I waited a long time for. So, just a message to people who aren't traders, like, I do all this analysis, and I've told people, especially in the Hex community, for a long time that trading isn't my number one game. Like, really, it's staking, right? And staking Hex in particular, it's like the thing that protects me. It's my core. And I think, like, later on in the conversation, we can dive into like what's portfolio allocation look like, and what's a balanced setup look like in terms of RH, those core coins. Where does LL fit into that if you're looking at portfolio allocation? And when you're talking about like exhaustion in terms of like, this is something that I've been thinking a lot about lately, is what, like, people are exhausted from the yield stuff. This happened outside of the Hex community last cycle with the yield farming craze and DeFi summer in 2020 and early 2021. And now it's kind of happening again. It's like, but it's happening in our ecosystem due to this dilutionary effect of all these new coins and all these sacrifice phases. And so there's a lot of interesting things playing out here. And so I just kind of want to get your take on what that looks like, and just like, because it's a very complex topic, complex subject with a lot of different nuance to it.
Yeah, there's a lot of threads to pull on there. I think that even some of the yield farming is like, that's the game to play, right? So even for Hexicans, I think where some of this, like, kind of crazy, I mean, there's a lot of reasons that kind of come to the craziness, but they primarily, like, if you look at most Hexicans, especially the top, I don't know however many holders, they are hyper like that. Like, that is the majority of their wealth in general, but especially of crypto. And when they diversified into Pulse chain, they have this portion of their bag where they're like, what do I do with it? Whereas, like, with staking, it had something. So, like, there was a very, like, set rhyme and reason, kind of a path to follow along. And now they've got things they feel like they should play with, right? Like, there's new toys here. They waited 2 years. Like, I want it to move, right? Like, do math, do something, right? So I think that because they also don't have staking, like, it's just sit in my wallet, I should do something with it, right? So it's like a little bit of a mind state change. And when you kind of shift from years, right? Like, people think of, a lot of times people in Hex think of their timeline in years, to I waited 2 years and now I've got like fresh toys that aren't locked away. It takes some time to like really kind of like mentally get around that side. So I think that when more, again, a few of these things are going to kind of like slosh back and forth, where I think that when there's, projects like L and everything finally gets launched over here, I think we're going to have our own DeFi summer on Pulse Chain. I think that we're going to see a big rush of a handful of projects. Fetch is a big piece of that. When it comes out, you're going to see project come out. And so I think that activity breeds activity. So as far as like where that next wave of Pulse Chain adoption comes from, I think it comes from just an absolute ton of cool stuff going on. Like people pay attention, right? Like people nicknamed the 2020 bull run DeFi summer because it was those things that brought everybody back in, right? It was like, what do I do? And it was like all this allure, right? So I think that we'll see DeFi summer on Pulse Chain. I think that that'll be the wave of right about the time as you start to see kind of bull trends and everybody gets excited again and is wondering what's going on. There's going to have a breadth of things that go on with Pulse Chain. And I think that that's what's going to kind of make it be a bit of a shining light. There's going to be a lot of activity going on, and activity breeds activity. So I think that in some ways, when they see that shift, I think that there'll be a lot of participants who come in and want to use these tools and play with different protocols and speculate. And I think that some will actually pull back a bit, actually, as they see that and they see the volume and they feel more comfortable with the charts. They won't be chasing yield. So I actually think that we'll see some more conservative players will actually see more stuff and do less. I think that if you see big volume and you're seeing a big buy and burn and you're seeing price move up on Pulse and PulseX, I think people won't be chasing the yield. So I think that some people that are maybe confused with yield farming or like looking for a shining light or a green candle, they'll probably do less. And those people probably should too. I'm a big fan of doing less. I recommend it all the time. So
you're talking about like consolidation back into what works, right? And with that, let's back it up to like basically we were talking before the stream about how marketing plays a role in this, and specifically with something like the Highest of Stakes movie coming out, right? So if this gets enough eyes, which I would say that I think it's a quality enough thing that it probably will be seen by tons of people. Maybe they don't act immediately in terms of like, getting exposure to our cryptocurrencies right away. But if they go see this movie or word starts to spread about this thing, the awareness is out there then. And so like then if that let's say little mini DeFi summer happens for us, or this fall or early next year, we get some sort of a spark and the price chart starts to move. I do agree with you twofold that yes, you'll see a consolidation of assets from certain users where they'll start to hold large percentages of the coins that are at the core of the ecosystem. And then you'll have another cohort of people coming in from outside of Pulse Chain flooding in that's helping increase volumes and increase activity. And then you have that third leg, which would be developers coming in and developing new things for traders to chase. And so you kind of need all the actors. And then with all that going on at once, you could see actual new organic adoption from no coiners, which is kind of the goal. But that comes after the green candles, and the green candles print when there's that coalescing of activity around those three major pillars.
Yeah, and there's a lot of people working on different ways to let no coiners and like lower that threshold for people who who can get value in. We're working on some cool stuff that'll be, again, right after our launch as well. But that's it, right? Like you want to have all these things. So, like Mintra, right? Like those guys have just kind of popped up again. All right, no Mintra means no NFT bros. Maybe you don't care about NFTs, but you want them on the chain, right? Like they bring in activity. We see that we have different shades, right? Like there's me and you, we're pretty monotone, we're base, we're level. We kind of have a rhyme and reason. We're not good cheerleaders, man. Like we're not going viral. That's not our wing, right? But like there's people who might even comment, roast us about something, do another image, do something like that, and that more NFT style, and that stuff has virality, right? So you want all these different layers around. So again, I think that like you said, I think we'll see some pullback. We'll see new, but all of that, like people start to feel more comfortable with it as well. And you see that growth in a variety of ways. And there tends to be a lot of resonance in crypto. Like you get a green candle, you get a bigger green candle, you get a second bigger green candle, everybody comes in and pile. Now, again, that's typically why we have blow off tops. But again, these things resonate together. They tend to be, very, very reflexive in how they hit. So I think
it's something to see how this plays out this cycle in terms of like, we have one of the most important on-chain traded assets at the root of this whole thing. And now we've taken that value and we've divided it up amongst a few other things. But what it's going to create in my mind is something I've been talking about for a while, which is if you remember back to 2015, 16, and 17, or now keep in mind, I got into crypto in February of 2017, as a miner mainly. But that parabola that was printed on Bitcoin and what happened with Ethereum from its launch through that 2017 cycle was a long organic parabola that was due to the effect of people wanted to get into crypto so badly, but there was not enough on-ramps into it. And so it created this organic, long-winded blow-off top scenario that where Bitcoin just did this tremendous run from $200 to $20,000. And like you could literally close your eyes and throw a dart at a coin that was on the top 100 on CoinMarketCap, and it would do 1,000x overnight. And I think those days are done for centralized exchange coins and listings, but that narrative may now shift to an ecosystem that has cheap fees where this can happen again because all of the volume and liquidity is going to be on the chain, being traded on the chain and can't be stopped. It won't be held back by the on-ramp thing. And so things can get really crazy this cycle because there is tons more on-ramps than there was in 16 and 17. But also you have like less limiting factors in terms of swappability. So like everything is swappable between like these cross-chain swaps and
So you have the
the
outlets.
liquidity's there. Yeah, it's all there. But then you also have that the trading's there on chain. So it's like you'll be able to see it live happening. And I just feel like at some point the data is going to be saying there's none of this, there's nothing left. Like everything is gone and nobody's selling. Which is it's a hard reach, but I'm saying that because of what I believe to be a 10x increase in user base. When you bring in 10 times as many people into crypto, we're going to run out of stuff to sell, and the prices are going to have to rise to convince people to sell it.
Right. Like that's the same thing like we talk about with like liquidity. Liquidity is low when no one wants to sell there, right? Like liquidity tends to follow price, right? So like, I'm not selling any Hex. How about $200 a piece? Yep, I'm in. Like, right. Like, so you find buyers, right? As you go up in scale, like that's exactly what a buy is, right? Like that's when that value exchange starts to make sense. I've kind of brought it up, and I think it's even something that we see in our community when it comes to like tools, right? So, perpetuals, HSIs, you start to add complexity in tools, and then people have less of a need to like leave and exit a system. So I think that's part of the reason that maybe we saw it in price, but you didn't really see it in user base as much in a lot of these places where people were still here, right? Like we didn't kind of have that, some of those blow offs. Again, even if you don't take RH, right? Like his low call was lower than what we saw. Now, again, a variety of reasons for that. But all I'm like leading into is that we had more use cases, more reasons to stay. I think there was less fright about zero, right? I think this last cycle, this last bear, we kind of saw that zero is not really it's not in the cards anymore, right? Like if you're talking about anything relatively blue chip, it wasn't going to break. It could have gone low and it could have gone low. It could have gone near zero, but it wasn't going to break, right? So I think we lost the idea of like, hey, you could zero out your assets, and that changes people's dynamic about wanting to get off the boat, right? There's a difference in a lowering of the tide and being on the Titanic. Like then you just jump, right? So I think a variety of tools, the market, and it kind of like running out of Bitcoin dying, Bitcoin zero, like that's gone, right? Like we don't really hear it. The last like true crypto will go away or be very, very deflated is really CBDCs, which are a variation of crypto. And I think with XRP, just the way the payment channels are getting more like crypto, right? Like we saw this with, I've tied back to it a few times talking about Gene Hoffman, but if you look at it like Napster and all the download software that came out, eventually BitTorrents, they didn't go away. The music industry got more like them, right? And I think that like they got disrupted, right? And that's an area where I do think that crypto is a true disruptor, is on this payment rail structure where, again, maybe what XYZ coin isn't the disruptor, but the tech won. Like it did disrupt it. Like FedNow, we saw them have to move into, Signet and a few of those other fast payment rails. Like they literally had to update, right? Like they had to move in to a better tech. So as we see CBDCs and things like that, like we're agreeing that the tech got disrupted and they're starting to become more like crypto, not more like the inverse. And it's the same thing with, as you brought it, with like exchanges. Exchange listing doesn't have the same pop that it used to. It's still important for a lot of different, market segments, but that's not what blows a coin up anymore, right? it's what like allows certain coins to blow up. So I think that we're seeing all those stages where not only are we moving into more DeFi in a lot of ways, if you were kind of in the edge of DeFi, you're more in DeFi. And then things that were centralized are still moving away. As you said, things are moving more on chain, far left legacy kind of entities in this example here. Now they're talking about, oh, maybe Bitcoin's not just for money laundering. And then the ones who are kind of like, it's okay. Now they're filing ETFs. And like, you just kind of see this progression kind of toward crypto. So I think that we're kind of seeing that sentiment at basically every level.
Yeah. Good time to pull up the sentiment stuff.
Whoop, whoop.
So in terms of like with the fear and greed index, let me get a quick refresh on this. Like, so it's the market is neutral. I mean, it's saying it's slight greed, but I would say the market is neutral, and this is probably a factor of things aren't going up every day. They're flat, which is really healthy for building structure in the chart, and it's really healthy for building that organic parabola I've been talking about in terms of let's go back to like with FTX back in the last cycle on this chart here, the total crypto chart. This was a long period of time when the chart went sideways on cryptocurrency, and then Sam Bankman-Fried gets on stage during this phase here, and basically says, where would we wouldn't have gotten this move without leverage. I remember seeing that video somewhere. But what we want is this long, slow buildup of waves, and that's really the most bullish thing you can get, because it gives large players enough time to accumulate a position, and then hold that position, so we can actually have like a decent run this cycle. So what I'm seeing in terms of sentiment right now is that the market's kind of was split until just recently, and now I think people are starting to get firm on the market. So it's not bullish necessarily, but it's firm in that the lows are in, and now people are scrambling to position, because all those people that lost their money on Luna and Celsius and FTX, now they have to reacquire their positions, but the prices are up double off the lows potentially, depending on Bitcoin's case, which really puts pressure on the market to make some moves to get money back in, to reposition. And you could see that here on this chart, and this is the crypto fear and greed index. If you look at it on a longer multi-year time frame, you can see the green line is basically it's over 70, so that would mean like things are starting to go parabolic. So this happened in 2019 when Bitcoin went to 40K, and then this happened again in 2020 and 2021. So DeFi summer is right here on this little bit right here, and then the next year, or at end of 2020, I remember this is when altcoins really started to pop off, like all the old ones, like even XRP popped off during this period. Yes, sir. And so we're not even there yet, and Bitcoin's like 15 grand off its lows. It's a matter of fact, this sideways price action on Bitcoin that we're seeing right now is just par for the course in terms of what you could expect from the market at this stage in the cycle. We could stay sideways here until end of September, and then still see 50K by the end of the year, depending on how this plays out. And that's exactly what this is saying, is like we're still down here at the 50 level. So things are, in terms of sentiment, the market is neutral, and this isn't a strong uptrend. You could see that we're in this rising channel. So sentiment is positive right now, and I wouldn't say it's overly bullish. It's just people quietly scared that they need to position as fast as possible, and this is what's going to start to really create the beginning stages of FOMO, and potentially seeing a shorter, quicker, explosive move, in the coming, like say 9 months.
I think something else that kind of gets highlighted there a bit too that's interesting. One of the economists, he used a term, he called them cross currents, and I kind of like that. I feel like that makes sense for us, where we have, if you look at like de-dollarization, okay, that kind of gives you some panic. If you look at like commercial real estate, especially in some big cities, like that makes you nervous. So like if I think we're kind of at a spot now where whatever you sort of lean, you could easily build yourself a case, right? So we're kind of saying that, hey, it's kind of in the middle to some degree, but it's in a heating phase. But there's a lot of, like, we could probably sit here and come up with 20 bear trap scenarios, right? Or bull trap kind of scenarios where this thing makes a leg down. But what I think is kind of interesting is, again, kind of that point of like, hey, we have more tools. This could change the shape, could be a healthier move. now there's certain fear in the market that's pushing people to crypto. Like crypto was basically like leverage on leverage on leverage, right? Like you basically take stock market, you're levered in Bitcoin, Bitcoin levered into altcoins. But again, you don't see this like flood rush away because there's not really a threat of zero. And so we kind of lost that threat of zero. But now we're starting to see with ETFs, some general acknowledgement from more legacy players that there's just other things to do, that it's an asset class that's not going to break, and that there's a move toward crypto. Like typically it's just like, hey, you get off your leverage, right? Whereas now you can see that people are actually staying in the asset class. And again, I think that'll kind of have that more gentle kind of oscillating parabola there that you saw, rather than just an absolute just swoop.
Mm-hmm.
There's reasons to look at negative market sentiment and move into crypto. And we've said that before, but we weren't really right, you know? And I think that this time, like that's a true narrative. Like that's a narrative that I think has come true, where if you're concerned about the dollar, that can be a reason to be in. If you think they're going to print more, that can be a reason to be in. If you want to be more jurisdiction market agnostic, that's a reason to be in crypto, right? Like when you look at Hong Kong, UAE, those are two ones I've been really keeping a big eye on. But Micah and Jacoby Management, those guys, they're the ones who got the ETF, the Bitcoin spot ETF, very specifically in Europe. Those things start to add buoyancy everywhere, right? Like if you're a player in somewhere in the world, and you realize that you have multiple ways to get off this thing, or multiple ways to still make value, then individual things don't really pull you off the ride. So again, I think that there's a lot of narratives that are feeling what we're getting to. And I think that that's, again, kind of your point. That's why we can see that greed, see that we're positive, see relative to that index, we have a high evaluation. I think all those things line up with a lot of what we're seeing. If you just cannot even step back away from the charts and look from kind of just kind of being agnostic about the markets. Before it's just been good market, good crypto market. Now we're saying, hey, I'm worried about the market. Maybe I should move some into crypto, which has been kind of a narrative around like gold. And again, so some of that digital gold narrative, I think, is being true. So I think we're seeing a lot of narratives that we've said were true in crypto actually being true here.
100%. So, and the technicals here is saying just that. So in terms of what you said, this was the banking crisis here. And this was so this is resistance on Bitcoin. Breakout off the lows, and then that retest of that low. And then I don't even know if you can see this on my screen, but the wick low is down here. And then it exploded off that level. And this is a weekly chart. So in 2 weeks, Bitcoin reclaimed from 20,000 all the way to 28,000, did an $8,000 move in 2 weeks, and then closed that high. And I think this is in the face of that, all that negativity. It's really proving your point that people are moving away from, or they're moving into a state where they're forced to speculate. And in this case, there is no risk here anymore. This is the moment, I think, the pivotal moment where Bitcoin was no longer going to go to zero. I mean, if for everybody, maybe that wasn't the case for some people, but generally speaking, when that banking bailout crisis occurred, and then you got this kinds of price action on Bitcoin, it's people scared of fear of the dollar losing value or a nation state going under, that pushes people into this as a long-term storage of value, like a savings account. And so there's that to it. And the technicals was perfectly played out at that perfect moment. And this is dealing in sentiment, news, more qualitative analysis. This isn't just the technical saying this. This was like an fundamental event that occurred that's proving what you're saying is true. And then so the other thing that I wanted to point out was on this most recent candle from last week when XRP kind of blew up, that gives now the SEC, or was it FTF? Which one is it? The Futures Trading Commission that basically has to approve the ETF, FTC. That has to approve that. They get like 300 days. So that's why I have this line here. This is a 300-day move going into until they have to approve or deny that application, right? And there's a bunch of applications that they could approve or deny.
Six from 9-10 figure plus managers. Sorry, what is that? Almost trillion. So from like 12, 13, and 11 figure players, I think there's at least 5.
Wow. Yeah, and if you do the math on it, just to give you something that's off the top of my head, this move here was accomplished with between $2 to $4 billion of funds. So the price moved from 26,000 to 31.5 roughly on just like $2.5 to $4 billion of true USD coin. I know that that's from the data that I was seeing running around on Twitter. So if 4 billion can do that, that's the high end. I think it was closer to 2.5. Can make the price of Bitcoin move that much. What is 20 billion or 50 billion or 100 billion dollars from all of these big institutions going to do to the price chart? And the reason why I laid out this 300-day runway is because it does give the price time to come all the way up here potentially and blow off, like a mid-cycle blow off before and during that launch of that ETF. So let's say it gets approved, 250 days from now. That's a long runway for big players to position and continue to push the Bitcoin price higher, which then in effect will help the entire ecosystem, altcoins, our RH ecosystem coins, to really benefit from the overflow of funds out of Bitcoin and Ethereum and into the smaller caps.
That's interesting. We could see, I think some of the fundamentals could kind of give that, not a double top, but kind of a cooling off period there for sure. Like if you kind of look at the way that draws out there, you see the sentiment. You could easily see, it kind of burned too hot too fast. People think that they need to get out quickly. Hey, we already hit our top. So say maybe you see a top in there where it, maybe it goes to say like a 50K range. And I'm kind of looking at fundamentals. I'm sure we could find some more accurate lines if we add some technical side to it as well. But sort of hey, we're almost at the all-time high again. Do I think this is too early? And you could see it cool, or maybe it blows past to say a 70, 75, maybe that low fib, and say, okay, these basically right below, right above kind of the all-time high, where everybody says, okay, hang on, I've been here before. I remember how this thing fell last time, and kind of does a pause and look around, and we see if the market cools from there. And then we see if sentiment, ETFs, altcoins, all these things basically kind of rebuoy, and then it goes off and it tries to find its true top there, and we kind of blow off from there.
It's scary because I can't predict. All I know is that what it's looking like is hundreds of days of boredom and a slow grind higher, and then something's going to happen. And there's two things that I think is going to happen potentially.
The happening is be right about in the middle of that line, wouldn't it?
Happening occurs right here. Literally, right around that May, April. Let's get the exact date because I do want to know. Bitcoin block. Uh-oh. $270 days. It says April 16th. So where's that put us? Right here. Right here, literally. So it's not far off my 300-day estimate. So everything kind of comes to a line of confluence right here. If the price were to go just flat, I mean, you'd run out of time to hold this trend potentially by January. So two things that I see playing out here. More likely, I think up first. Definitely in the realm of thinking that we have a double bubble cycle coming. I just don't know what it looks like and what the total time frame looks like. So quick draw. Potentially this is a slow grind higher, and then explosive move leading into that halvening, plus let's say an application's approved, and then this like long-term like sell-off that takes us, potentially a retest of 30K, right? Maybe a double bottom or something occurs here, mid next year, end of next year. After the original liquidity comes up, touches 50K on Bitcoin, and like profit taking end of year, what could help this occur within this kind of time frame of, step back. So what could occur in terms of like there's another ulterior argument that we're in for a crash between October and November. Well, what would that look like? Potentially, you need to spin up hard, maybe the mid 30 to high 30s, 40K, and then rates on the interest rates from the Fed would be dropped in the face of some other form of adversity. What does that look like? I don't know.
Commercial real estate.
Definitely a piece of the puzzle would be commercial real estate. Yes. Obviously, for those that maybe have been living under a rock, that's kind of like a dying investment thesis right now because everything has shifted online in terms of office work for sure. So yeah, this, COVID really accelerated that, and I think we're going to see that could potentially play out, but would it happen this year? The Fed says they don't want to really lower rates for up to 2 years. That's the target anyways. So, but if they were to drop rates, I'm not going to say the when, but if they were to drop rates, historically what happens is the stock market makes a big crash. And I'm not talking about like dropping a percentage point or like a half a basis point or something. I'm talking about like a drop to near zero, like just like we've seen before. So let's throw that up on here just to compare and contrast. Fed funds. All right. So like this blue line, can you see the blue line all right?
Oh yeah.
Okay. So the blue line is when rates were near zero here, Bitcoin went parabolic. But before that, rates were high, just like they are now, and they crashed. And that's what created this sell-off in equities and in Bitcoin that was the COVID crash. And it's because of this very thesis, which is I think this is an important thing to relay to people, which is that if you can sell assets at a high price, this would be like 14K Bitcoin to 10K Bitcoin, you can sell them up here, and then you get news that Fed's going to drop to zero rates. Well, then why wouldn't you sell off your assets at a decent price and then borrow a bunch of money with almost no interest rate and then buy back your assets at like a 50, 60, 70% discount? And I think that's the way to think about these like inversions that occur on interest rates. Now they're high now. They're big. They're higher than they were back in 2019, and then now they paused. And these pause periods usually are like a 6 to 7 month window. So last time it was from December of 18 to July of 19, where they went flat on rates before, capitulating a little bit and then dropping rates. So look at how this could almost play out similarly. If it does, I mean, you're looking at that drop coming next year potentially. But that's outside of the time frame of some of these guys that's calling for a drop in equities this year. That would mean that this rate drop would have to occur like around that October, November timeframe. And I'm not really in that camp right now. I'm in this camp that Bitcoin's going to continue to grind sideways and rise in value slowly in the most boring way possible as this liquidity grab is set up. Basically what we've done in terms of market making right now is we've set the price of Bitcoin, double what it was down here. And now all the big fund managers have to basically use their clients' money to buy back the asset up here between, let's say 25K and 35K, which would reabsorb tons of the supply. And then and they're doing it on somebody else's dime. And then once all of the repositioning has occurred, then they can move the prices up.
Everybody shuffles, finds their chair, and then turns the music back on.
Exactly. So this is kind of what I'm thinking.
There's a few things that you laid it out there, and I think sometimes it can be a little like confusing, when we talk about like the rate and asset price. I think sometimes it's because, like you said, there can be that reversal, and sometimes it's because the things that you think would push up price or push down price, they can be sort of counter influenced by the interest rate. Like we've seen, I think the two big assets that people see that is in housing and in automotive. So even if prices, say on cars, they start to drop because they're overheated, right? But because rates chased, they were overheated because, as you saw all these assets run and inflation, then they start trying to chase it with interest to try to bring that back down. So they're already hot, they cool off. But even when they cool off, you think, okay, well, they're down now people can buy them. But because the rates are insanely high, like you see the most of the big manufacturers are putting out discounted rates at 5%, 6%, 4%. Well, even if you drop from, what was already kind of an astronomical pricing, even if you drop 10%, 10% is a lot. You're talking about a lot of inventory from a lot of different people who are holding the bag on those assets. And then all of a sudden you went from rates where it was 0 for 60 months, 0 for 60 months, 0 for 60 months. And then all of a sudden those rates trend that pushes the asset prices down even farther, because even though you see it as far as pricing that those assets start to correct. They haven't corrected as far as people's ability to actually buy them yet.
Yeah, exactly. People are like they're no longer able to borrow because of the elevated rates for so long. They're getting killed on interest payments.
Yep. And that's part of what, again, like just lightly on that commercial, the commercial paper issue is part of it was a bit of a game where they weren't just buildings, but they were assets that got treated very differently. And those things are also typically on much shorter term notes. So part of the reason we haven't seen some of that pop and people bring up, the office buildings or even like housing, like, why don't you just lower the price to kind of bring in occupancy? Because if you lower the price, you change the way the deal is going to work. And most people who own big commercial buildings, especially like the massive skyscrapers, all these things we think of in like big metropolitan areas, they don't treat it like a building. They treat it like a financial asset. Like they don't think of it the way we think of it. So you start to go in there and lower pricing for occupancy rates, then like you lower what the projected revenues could be. You lower their ability to say, hey, I'm operating at a loss. And you start to kind of play with some of the physics of why those guys own those things. And so they don't want to. Like in a lot of ways, it's better for some players in some of those positions to have less revenue, less cash flow, so that they can report the loss. They don't want to have to re-up the contract at a lower revenues, not have it rebought. So again, you get to some places where kind of conventional wisdom is very, very wonky in some of those, say like 6-month windows where 2 + 2 doesn't equal 4 for a while when it comes to like asset prices, when versus what you think they do versus inflation and rates. So yeah, having some awkwardness there wouldn't surprise me. Like it's the game is all out of equilibrium. So you can't sort of think about each individual stat by itself because the game doesn't make sense yet. Like it's still sorting itself out. Like everything isn't lined up.
I agree, man. It's a complex time. And so what's a good capstone for that? There's a lot of factors at play, but one factor that's for certain is that the global market has decided that Bitcoin is a good hedge in times of distress. And you're even seeing that in its parallels to performance with like something like gold. So, we've seen like the dollar recently kind of tank in value. And then at the same time, gold is like continuing to rise up. Now, remember, this is a weekly chart, but so gold's popped. This is a $12 trillion asset class. It's up 5% on the wick to wick, but it's up 4% wick to candle close right now. And so it's doing well. If I throw up Bitcoin on here as well, you can see that there's a similarity here. I'll delete some stuff. There's a similarity here on their price action off their bottom. So gold actually bottomed first and then Bitcoin bottomed slightly after, but they're both acting as stores of value in times of uncertainty in the market in terms of where can I go to protect myself against inflation, and where can I get returns over like a multi-year basis, and not have like interest payments affecting me in that, right? If I go and take my money and invest in a property or something bigger than a Bitcoin, maybe that comes with like an interest payment at a time when rates are elevated. So maybe for me, it would make more sense to go into an asset that, I could take my extra cash or cash flows and put them into Bitcoin at no interest rate because it's just buying liquid off the spot market, and hedge against both interest rates, uncertainty, and yeah.
Another portion there that's interesting that they have started to, at least sort of mirror each other to some degree. Obviously, again, what those charts are saying and how much money and value is moved around is all very different, but that they have a similar shape. Some of that I think also comes from culture. So something that like stuck in my head, I'm still not even sure why it bothers me so much. And I knew it already. But I was in a space, Gary was there, Funding Jim, me, him, and George Gammon were talking mostly about CBDCs. And one of the things he was talking about was controls on currency and cash. And I can go through an airport and I can't carry more than $10,000 without declaring and all these problems, right? He said, but if I wear a $200,000 Rolex, no one says anything. And for some reason, that's just like weird. And that's really the reason I was like, I kind of want a Rolex now, is in my head, it's a physical NFT, right? Mm-hmm. And the reason I bring that up, seeing that sign there, is the fact that Bitcoin has started to act in more ways like gold and as a true store of value. I think has some more effects with just the culture. So there's more and more people of value and higher value who move around, where being able to operate in different markets or just being able to have access to that value in more places becomes more and more important. So as we were kind of bringing up, I think some of those narratives are becoming more true or actually true versus just being outright incorrect. Like there's more of a need for that, right? So that's something that, let's see, when I was very first getting in and very inexperienced, I never thought about the idea of like, hey, I need to be able to go from A to Z to B to Y and all these different places and be able to bring that value around and have access to it easily. Like now that matters. So if you look at more digital nomads in general, and just not even digital nomads, but nomadic capital, like people have access to the more markets, the ability to just basically have that Bitcoin liquid everywhere. Like in our head, sometimes we think about it that it's everywhere. But that hasn't really mattered to that many people. It matters to more people now than it ever has, whether you're Russians trying not to be Russian and you're moving around, whether you're US and you want to be in different places, whether you're from Singapore and or getting access to all these markets, or Dubai or Saudi. Like the ability that your Bitcoin is essentially always in your hand, that matters.
100%. And so this kind of sets us up for like a cool talk about like the store of value in Hex, right? So this is something I've been thinking about is so like this is what the world's looking at right now in Bitcoin is like year over year. This thing has only had 2 down years, year over year, and year end percent change. So last year, let's say this is going to 2020. So from 2020, it started at 7 grand, went to 28 grand. And if you project this out, I think it had one other negative year, which was last year. But generally on a rolling basis, it's doing like 150 to 200% year over year on average. So it doesn't even have to do that for big money to be interested. Even if it did 30 to 50% per year, Bitcoin, like people would be happy with that. And so I think the gold standard in terms of like what Hex is competing with is Bitcoin's year over year return. So all Hex really needs to do to stand out is pay yield and beat that 200% annual return. And do I think it could do that? I believe that it's going to do way better than that because it's so early in Hex's life. And really there's only like 2,000 wallets that even have a significant portion of the supply. So any meaningful number of people getting into Hex is really going to like be able to absorb a lot of the sell pressure. I think a lot of people have been conditioned through the last 700 days of downside on Hex that it's going to take so much to get us back to 20 cents on Hex on Ethereum, or it's going to take so much to get to break that all-time high. But in reality, it's not really going to take that much. It's just going to take the right circumstances.
Well, and Hex is more interesting, right? Like there's I think if you see it, especially as a store of value, right? There's I've been talking about for the last like year that Bitcoin is way more interesting when you're looking at Lightning and ordinals and inscription and Snore signatures. Like there's really, really cool tech there. Like the idea that like Bitcoin's a boomer coin, that was sort of true for a while. That's not really factual anymore, in my opinion. But when you're talking about just as a store of value, like Hex is wildly more engaging. So I think that if you look at, like, to your point there, if it's maintaining outperforming as a kind of pure store of value, it's a way better game. It's way more interesting. So I think that if we do see that play out, as people become more, again, comfortable in the space, they stop wanting to leave and versus where they move to. So, we can see that variations play out, but it wouldn't surprise me at all to see that game Hex would really outperform because it's a better game.
Yeah, and so, well, if BTC is the gold standard, then let's measure it against BTC. And so this is like, to me, crazy that we have this opportunity in Hex. Like the price has performed so well this year up until the main net. Here we had like a 700% run from 1.7 cents all the way up. And then subsequently, we've seen this huge like decline in the EHEX price. And remember, this is measured in Bitcoin, so this is measured in Satoshis. It just recently tapped what was the lows back in 2020, because Hex is now back, 9/10 of a cent, 1 cent, and Bitcoin's at $30,000. But it doesn't take that much economic energy on this low liquidity on the Ethereum side. There's just nothing there, like $1 million or $2 million backing it. To push this price right back up into this channel, create some sort of a structure, and then potentially a breakout. And so it's twofold. EHEX in particular is very interesting to me because not only the one thing that this isn't showing is the yield that you're earning. So if you did set up a proper staking ladder it's hedging against the downside against BTC at the same time as being able to perform tremendously well in terms of price appreciation. And it's that to me is exciting because Hex on Ethereum is like the GOAT in terms of on the Ethereum side, you can pump the price with very little money. And then if you want to sell, you can bridge across your eHex over to Pulse Chain where there's $137 million of liquidity and exit over there and not hurt the price. So it's like this gangster asset that can benefit from both low liquidity and thick liquidity due to the way that PulseX's liquidity system works, being a fork of Uniswap v2 versus the way Uniswap v3 works on the Ethereum side with almost no money backing it.
And there's a lot of, again, that we haven't actually appreciated some of the tools that are built on top of Hex yet. Like, so not only like when we're looking at these kind of trends of cycles, this also hasn't shown what Alex and the Hedron guys have done. Like that hasn't really impacted the chart yet in the cycle. Like to see what having extra means of taking yield and for the same players, what having HSIs, what having reduced gas fees down. The same thing with Dip Catcher and Gold Key. Like those guys and other perpetuals, there's been extra game mechanics and ways to take Hex off the market that are not reflected in those charts there. So I think we can get a lot of cool ways, but I brought this up even before the Pulse Chain launch. Whenever you're picking between two things, if one is kind of more expensive, so if you're looking at say this eHex PHEX narrative, if you pick PHEX right now, and I'm not saying you're right or wrong, I'm just explaining what that decision is. You're paying 2-to-1, assuming that you're right. So you're going to have twice as much exposure to eHex for the same money. So when it comes to buying things, when you look at some of this is you're paying for certainty, right? And so when you start to get discounts and you start to get that type of a 2-to-1, 3-to-1, are we that sure? Because that's interesting to me. So this is where like I always talk about, like I'm never that confident in evaluations. And when you start to have that much going on, I'll just assume that you guys are overvaluing being right. And I say you guys being the market, right? So when we start to see some of these things move that far off, you're that far off BTC, that to me feels like some short-term sentiment. And that's when I'll say, hey, like, again, if you say you give me 1-to-1 right now, okay, PHEX has the big strong narrative, new chain. Again, everyone knows kind of these sides, but we're not talking about them at 1-to-1. We're talking about them at, what is it, closer to 3-to-1? I haven't checked. What is it?
Currently, right now, eHex is sitting it's like 2.3-to-1.
Right.
Roughly.
So that's a big difference. So like when you start looking at like future growth, like this is why when I talk about ratios, I think that ratios are that's not a very natural thought process for us. But that's why I like those sports betting analogies. Are you 2.3%? Are you 2.3x sure? Would you take 2.3-to-1 odds? Because that's what you're doing when you buy one. Now, again, buy whatever you want. I'm just saying that's what that math is, right? Like that's what that ratio reflects. So if you're sure, buy the one you're sure on. But a lot of times I want other people to pay for certainty and pay for their guess. And I'll just take the upside. I'll take the cheap one. So a lot of times that's what that price reflection is to me. Other people are willing to bet on a choice. And I think that both are good. I think that both go up and right to some degree, which means I would rather not pay for certainty.
Yeah, dude. When I'm looking at these ratios, I think to myself, who can move the chart? The guys that are bringing in like $1,000 or $2,000 every month, or the guys that are looking to bring in 6 figures or 7 figures at a better ratio? Like if I could take even let's just go from fresh cash. So if I'm bringing fresh cash in and I'm going to bring in 6 figures, like if I could get, I don't know what's the number. Let's say 900, or like let's say 1 million Hex, but on one chain, but I could get 2 million Hex on the other chain. Am I not gonna be somewhat intrigued potentially? If I'm bringing in 6 and 7 figures, is a gas fee on a rolling stake really gonna affect me, or do I have like a longer term vision of what that's gonna look like when Hex is trading back at higher prices? Do I even believe that Hex can trade at higher prices? The guys that are gonna move the chart know that it can trade at higher prices. They've seen it just like back in 3 or 4 months ago, how high Hex went, how fast it went there. And it didn't take a lot of money. I think we traded like $100 and something million, and some of that was washed back and forth on the way up and down. But like that's a lot of money that was in and out and extracted. But yet here we are, and all of a sudden one of them lost value or didn't lose. Like let's say that EHEX continues to trend down against PHEX. This is a clear channel, right? You can see this as a clear channel. PHEX is gaining in value against EHEX. You know, what's the narrative driving this? It's coming from people that have big Pulse and PulseX bags that are farming for ink, that are also staking Hex over there, that want that ecosystem to pay them as much as it possibly can now. So that's like where the sentiment comes in, right? And I think like there's still on the table right now for some of the market to say, hey, you know, EHEX could go to zero. Now, we've seen this argument with Bitcoin where Bitcoin could go to zero. Even Bitcoin Cash could go to zero, but they didn't. They held their value. Even ETH Classic did a 4,000% run last cycle. When
Did it really?
Yeah, dude. And so
I didn't know that.
So let's you know, so my analysis extends way beyond just, you know, the typical looking at the Hex chart, right? So like when you look at this is ETH Classic.
Quickly while you pull that up, ETH Classic had a 4,000% return. You guys really 2.3 times sure that EHEX won't do well? Anyway, go ahead.
Here it is from wick low on the COVID dip to wick high, it did 4,900%. So like maybe you captured somewhere in the middle of that low to the candle close high. That's at least 2,000% in 385 days. Now this is an asset that's trading at $5.50 and went up to $118, $120. Actually, it exceeded that. So it actually went up to a wick high of $175 from a wick low of $3.50. So, you know, and that's on a weekly. So like, what does that look like for Hex at a penny on one chain? And when people can bring in thousands of dollars a week or a month, and then it's not just one guy, maybe 10,000, 20,000, 30,000 people are doing that, and they're DCAing in when the chart is actually moving up and to the right, you know, it's easier for them to absorb supply at a penny than it is for the market to absorb supply of ETH Classic at $20, right, on this parabolic run. So my point is that due to the decimal placement of where the valuation's at relative to wage growth, relative to salaries and stuff in the economy, people underestimate how high both of the hexes can go, and they're going to go there together. They're not going to be like one or the other. Like, so again, let's look back at that. Let's look first at Bitcoin, or Hex Bitcoin chart.
Another asset thing here too. A lot of times when people kind of brought up like some strategies around launch, and I think it kind of plays out with some of the parallels we're talking about here between currently ETH and Pulse. Things can affect one side asymmetrically. So let's say, just for example, like we just saw what multi-chain did to like everything on AVAX, right? Okay, so maybe it's one of those things where this channel does play out, but if you hedge between different points of failure or growth spurts, so it can just basically, the parallel I'm trying to draw is when people said, hey, like, should I be EHEX, PX, should I move around? I wasn't sure, which meant I waited till I got more information. So I was able to take a big advantage of that big dip on EHEX, not because I knew EHEX was coming, but because I bet that I wasn't sure, which meant I stayed in stables, and I was able to basically take advantage of some of those big lows between them. So even in some of this EHEX, PX, if you have something that's hyper bullish on Ethereum, and that tide raises up, it just gives you opportunities to play between the two charts. But if you don't have any skin in the game, if you don't have one on each side, then you can't take advantage of, as that ratio becomes out of line, even if it does stay in the trend. Like, it just gives you opportunities there if you're not super biased one side or the other.
100%. And so I just want to encourage people to think about, you know, your little opinion. You know, the people that are most vocal typically don't have the most money. Like, your little opinion with your little bags isn't going to be the thing that's going to affect the price chart. And at some point, this ratio continues to fall to 3-to-1 or 4-to-1. The amount of supply that can be flipped or absorbed with just a small percentage of some of these hex sharks or hex dolphins back into the EHEX side is going to be like crazy how much that's going to rubber band the price. And so right now what you're actually seeing is consolidation and bull flagging along the middle of this channel, which means this is actually kind of technically bullish right now. It actually produced a falling wedge, then broke out, tested 2-to-1 twice for a double top, then broke down, but there's still support here in the middle of the channel. And there's
still novelty, right? Like there's more in this, like charts are incomplete information, right? So we're looking at EHEX and PX, and we're only looking at between the two, but you know, the outside factors of, you know, kind of a sloshing of money into Pulse chain and yield farming, those things go on. Like I already talked about, again, as somebody who's building and launching stuff on Pulse Chain, that I think that there'll be a subset of people who say, okay, all this stuff's out here now, and then go back into sort of those kind of core coins. It wouldn't surprise me to see that here, that there's a lot going on, and that you see people remember the one that brought them to the dance. So again, I've said it before. I pretty much just buy whichever one's cheap. I don't overvalue my own evaluation. I basically just take these things in DCA because I don't have that, hey, I need a 10,000x or 1,000x or any of these things. I'm just trying to get it on the fairway. And if you start trying to tell me again that there's the same thing I said about Pulse and PulseX, right? So, 1-to-1, yeah, I'm probably going to lean Pulse, but 2 to 3 to 1, that's probably where stuff belongs. I don't make trades. 5 to 1, 6, 10, 20. When those things got way out of whack, that's when I start to make moves. And I guess that's what I'm referring to here on the CHEX PX is that, again, that people can be way too sure about where they're at now, be unsure about things that can come hyper affect that chart that aren't just EHEX and PX because they have different, in like the way they'll react to certain things on the outside is not the same. And if you overvalue how sure you are and those ratios get out of line, like that's an inequality in the market. Like 4 to 1, maybe that's where it makes sense, right? Maybe we just ebb through there and 4 to 1 stays where it's at. That just seems like an odd bet to me. And like, I want a piece of the other side of that.
100%. And another, it's easy to support EHEX when everyone else is footing it because like, look at how EHEX is holding up relative to Pulse. It's literally just range bound between 75 Pulse to 100 Pulse to 1 EHEX, just range bound. And it actually most recently had a breakout, retest, and it's consolidating. And it's just, the valuation of EHEX is holding stable inside of this channel. It's trying to even break out higher. But, at some point, it seems to me that right now these little wicks is saying that some people's arbing out of EHEX while the market is still unsure, but that it's showing that it wants to continue to maybe hold this trend and actually gain. And so, I want to kind of flow the conversation into like basically that the hexes is what's leading this pump off these lows, like both of them. Like Hex is what is pumping the prices of Pulse Chain. It performed like a Hex on Pulse. Let's see, where is that chart at? Switch this back. So again, you can see the EHEX. Oh, that ain't the one. Here it is. So PHEX has performed tremendously well off these lows. Technically, it did 150%, and now it just flipped this previous double top here as potential support on a double bottom. So, any kind of coming back down here and trying to test into the 21-day moving average is totally healthy and normal for a bullish environment. But even just rejecting off pushing off the top of this channel of this upper trend line of this channel here, that's bullish. And now it's just like resetting. If the 20s of 21 continues to rise, it can come back in, test again, punch off that level. Hex is really pushing the Pulse Chain ecosystem higher right now. And so because PHEX is doing a lot of the heavy lifting, EHEX is allowed to do the same. Like basically it comes back up and follows right behind it and performs, very well as well because people can arbitrage the yield. Remember that at the core of this whole system is that relatively risk-free yield that you get from a contract level of yield from Hex, from staking it, which that's not even can be true for PulseX or Inc. Like there's a lot of other variables and factors that goes into getting yield over there. And so I think that is not unlike Bitcoin mining where there's that consistent auditable yield that's coming out that, there's only one variable you have to account for, which is the price. But it's costing you nothing. You don't have to go buy hardware and anything. You're basically just what you get your Hex for off the market, and how long you're willing to pay in terms of time is going to dictate your return. And so at that root, that's what's going to drive this ecosystem higher in this first wave for the RH tokens.
Yeah. So like, again, just like looking at like outside force affecting them differently, we talked about them earlier. So I would say that if you could probably, I think the forecasting would be less accurate if you look at, say, like the endpoints of like the large perpetuals. It's easier for a single player to be able to basically like front run all those events on Pulse Chain because that individual cost is much less. There's more people who can participate in sort of a front run event than can on EHEX, right? So like, let's say I don't know the names of all of them. Those guys build cool stuff. I just don't keep track. But say 5 years from now, 3 years from now, you have these big singular giant pooled events, right? From all those variations. Setting out now on eHex, setting out like stakes that have some length of time to accrue yield that front run the price on those ending. That's way easier on something like Pulse Chain than it is on Ethereum. So again, that's those places where I think that we could see like deviations from the same shape, and where the same tools, they're like, again, no one cared about these the first cycle, right? Because fees were cheap. Who cares? But then you saw fees get high and necessity breed invention. Well, if we see a similar event where we have a fork, again, kind of pun, a fork where there's two different fee environments, then those things will get affected by the perpetuals and HSIs differently.
Mm-hmm. It's really bullish for Hedron, for the HSIs, and for the perps. It's super bullish because, as you've outlined, if fees is really going to be the driving factor for price on either chain, then you'd want to now recognize the opportunity in some of this stuff, like DECI being down. I think on the Pulse chain side, the perps are actually performing pretty well, but DECI's still at a decent discount relative to Hex over there. So like that's a team.
Yeah. Just sort of kind of chunk on there, but I wonder how much of that is, again, is just a bit of immaturity, and we just like the stuff on Pulse Chain right now. Like as we get a year or two, again, remember, these are long plays. Like these are multi-year bets. So one, again, the fact that there's a discount at all, again, we've talked about that. That's something that you don't see that often in traditional markets where they deviate that far. Mm-hmm. But that may be something that discount is less sticky, or excuse me, it would be more sticky on Pulse Chain as they realize, hey, these are timed events that it's easier to front run from a variety of reasons, because we're not in that same fee environment that we are in ETH, where not everybody with $1,000 right now can say, okay, well, in 5 years, there's a big stake coming. I want to start, basically backing into that. There's not that same there. It's more difficult to do that on ETH than it is to do on Pulse Chain.
Mm-hmm. Yeah, and the other factor that's leading to the immaturity in the markets in terms of the perps and the HSIs is the overall condition of the market. So what am I trying to say? Like the market's super immature, and like, for example, with like the 10-year stake, Hex is already not being priced properly at its base unit. So how could it be priced right from a futures perspective? Like, you kind of almost see the same thing in regular markets, where like the futures market might deviate from the spot price of something, or like that there's a level of manipulation that can occur because of a lack of liquidity there. And I think that's what you're seeing in terms of like these coins. Like there's just not a lot of liquidity available on the market to participate, especially for big players. But as Hex gets really expensive on either chain, the money's going to flow into the best deal. And so regardless of liquidity, as things get really bullish in the future, there's going to be opportunity to speculate on these things too, not outside of just actual real core value that's inside the stake that's in there.
And some of that just comes from like time in the market, right? So, I know you have Crispy on here. He's someone that I enjoy a lot. He's been in a lot of the Telegram rooms. I've talked to him for a long time. Crispy's one of those guys who doesn't always talk all that much, but go give that guy a year with something. He'll figure it out. You know what I mean? Like he's that type of guy who will sit here and be like, hey, I feel like the HSIs are off here. So as you give some of those types of players like him and yourself time to start to price these things more accurately, they'll start to be more accurate in the future, right? And like that's where again you can get these deviations away from what you see in the charts now. Like the charts don't reflect that this is where we're pricing them, but there's, like we brought up earlier with like say some like the Fed meetings, we're not accurately pricing these things in yet. We haven't had enough time with them, not just chart data, but even time to really appreciate what they are, like to see how those things can tighten and when they can be at a premium again. Like let alone how much does the discount change, how much they change from chain to chain, but also just when are these things going to be at a premium? Like that's like DCG is another example of this kind of a derivative market where you've seen it be what is it, 30% and then 40% below. I mean, like it's had a 70% range over its asset, right? Like I know for sure it's been at a 40% discount and just pulling on the price, but I think it's been as high as a 30% premium.
You're talking about GBTC?
Yes.
Okay.
I said DCG. It's the parent company. I always pay attention to them because they're in that lawsuit. So I've been really interested in watching Barry Gilbert and all those guys.
Just quick side note, totally, you don't have to like be right about this, but do you think that they're at risk of?
Yes.
Yeah, they are.
Yep.
Going under. Yeah.
Yep. Yeah. So a quick tangent. So this is the kind of stuff that it kind of interests me. They not just, so again, the reason I called Grayscale DCG is that's their parent company, and they own a dozen different things, and none of them are going well. CoinDesk, they own another mining company. They're just underwater altogether. They've way overcommitted to Gemini. Now they're being sued by the Winklevi boys. Like, I don't know how we'll kind of see that full structure. The way the trust comes apart is really interesting because you cannot choose to take custody. So if you have 10 GBTC, if they get liquidated, you can't just take the Bitcoin. There's a few rules and regulations about the liquidation of trust, but basically they're going to give you dollars. You cannot take your Bitcoin. So I've been really interested in this for a long time, since October of last year, keeping up with how that goes. Like, they're getting sued now, and it's not for like a couple, it's for like $1 billion, like $1 billion hole. And they have almost no way to dig that out. Like, none of their other businesses are profitable. This was their shining kind of light on the hill. It's at a massive discount still. So like, there's a lot of holes in that ship. Now it's one of those that I kind of feel like it's too big of a target in some ways, that someone's going to come take that off the market. But if we're looking for a dip in the middle to kind of smooth out the bull run and get another entry point, it could be these guys here, and they own a lot of Bitcoin.
They do. I think it's like 600,000 by this point. We can check in a second. Yeah, so they're right now GPTC, which is paper traded Bitcoin. It's at a 26% discount. So it did get up a little bit here on this most recent pump. But if I'm looking at these guys, I'm basically looking at this from a third person perspective. I'm thinking to myself, like, this is like shark smelling blood. They're like, this is a potential takeover of the entire crypto space. So you're telling me that if we tank these guys, bankrupt them, attack them, we could get 600,000 Bitcoin, like spot Bitcoin? What would imagine if that falls into the wrong hands? Like, imagine if, someone's going to come along and buy this thing out, and it's not going to be, the regular OG freedom fighting Bitcoiner guys. Those guys are not getting this Bitcoin. Like, this Bitcoin is going to go to some huge fund, right?
Sailor, BlackRock, Fidelity,
someone maybe even private that we don't even know, but obviously those are the easy ones to maybe say would get it. But yeah, this is a huge fundamental thing to follow. So props to you for tracking this. And, of course I want to be in the loop too. So if you hear anything, please let me know, because this is going to be an event that really could change the entire future outlook for Bitcoin in particular, but it could really shift the trajectory of the crypto space as a whole. And I think as these markets mature, we're setting up for what I would say a less volatile future for crypto. A lot of the mad gains times are going to end in the next potentially. I don't want to say this because it hurts, but this might be the last cycle where, like, we can play this like game of like new ticker launches, goes up 100x. Like, we might actually need to see the Amazon and blockchains launch now to get real returns, because there's no more allure to, what's that Bitcoin thing? It could go to zero. All of the risk is like getting zapped out of cryptocurrency, and now it's becoming mainstay. And so once that occurs, and especially if this gets absorbed by a big firm, that's going to completely dampen the volatility. It's going to soften the gains that are possible, which is why I feel so good being in true DeFi here with Richard Hart's stuff, is because it's really the only thing left that can perform if all of the centralized stuff gets backdoored.
There's There's a couple of cool points there I want to pull on. So one is to keep track of this. I think by far the biggest one to follow is the Winklevi Gemini lawsuit with them. That's a big part because right now there's like an IOU for $500 million, $1 billion. And the only real profitable thing left they have is basically the management fees of that trust. So I think the sort of crux to all of that is basically their lawsuit with Gemini. There's another interesting point that kind of comes into some of the things you're talking about, where I bring this up all the time, that sometimes we view these things way too much as crypto people and not just as financial professionals, right? Whether we are or not, but like that's how the lens we should view it. So another interesting one to keep track of, there were a few firms that had massive short levered positions on Tether and a few stable coins. So why would you do that? And you kind of, a few of those threads you were just bringing on, basically, what can be manipulated? Why would they manipulate it? And sort of like what the pros and cons are for how this thing is controlled. So let's take something like Tether, right? We've heard Tether FUD for who knows how long, right? Okay, so because it holds a peg, what's the highest Tether can go? $3, maybe $5 on a weird day, right? Okay, so to give myself some room, let's say it's $4, $5. That means I can go 20x short on Tether, and the only real cost and risk I have is basically the solvency of my trading partner or the opportunity cost of those funds. But if Tether ever breaks, I've got a lottery ticket that doesn't cost me to cash in, other than essentially some opportunity cost in trading in a small things. If you're talking about like you can take multiple $1 million and put a massive leverage short and basically say, Tether can't pop. It can't really break this thing. People will redeem it back down. So I can't really be liquidated. But if it ever breaks, I bet huge. And that's an awkward position where we see sort of a difference in a kind of a legacy mind state versus how we would view things in crypto. In crypto, we'd say, like, why would you lever a stable coin? Because I can't get burnt, right? So we saw this to kind of what you're getting at about control and trying to dampen some of that volatility. We saw this with the positions that a lot of these firms were in with GameStop. That was one where we saw those stomp out the shorts and all that kind of narrative. And then also in 2008. So if you're in those channels and you sort of know what the cadence is going to do, they don't need this huge sweeping volatility. They don't want to guess and play that game. If I can keep it in a channel, then now I can push the leverage in an insane way. So maybe it's only 2 or 3%, but as long as they know they're not going to get popped because they have way more control of the price and supply, they turn up the leverage and they lever on the way up and they turn off and make money and they lever on the way down. And as long as you have it in this controlled channel, they're able to sit there and keep scraping and scraping and scraping and also pushing the leverage on these. Again, that's what we saw with CDOs and a lot of those different instruments in 2008. And it's the same thing you saw in GameStop. The only reason they were that levered against GameStop is because the game is so rigged. They never assume that they're going to get their ass busted for pushing way past what any rational company would do. Some of those shorts were multiple times and levered the size of the entire GameStop company, right? And that's why that push up price was so radical and such a big deal, is it kind of exposed them that they were like, hey, we're not just the ones dancing. We're the DJ too. We're the ones playing the music. And so that's why these things can be so detrimental about where that Bitcoin goes, is like that kind of impact. It's the same thing we see with exchanges playing against their players. And even something, again, if you want to get a little dark for just a second, but even like in the healthcare system, money's not in the cure, it's in the treatment, right? So they don't want to solve problems. They want to sit here and control the cadence of that. So keeping those things in inside of these channels and making sure that they can't get popped for leverage and can stay basically hyper aggressive in a way where they can't get burnt for it. Like they don't view these things the same way we do. So I think that stuff's important for context, where why would you want to dampen the volatility on Bitcoin? Because they're not playing the same game.
Mm-hmm. They can make the world can make a lot of money if Bitcoin goes up, 3 to 4 grand year over year for the next 10 years. Like, that's fine. Like they can buy the lows, they can trap the price, so there's a huge opportunity there. But the issue with that is Bitcoin still isn't completely tamed, and there's enough supply out there, or the right amount of supply, so that you can still get these huge squeezes in price, right? So in both directions, you can still, there is still opportunity there. But those days are numbered, because if something like this were to occur where, you know, let's say BlackRock gets 650,000 Bitcoin, they can control the price for decades with that much, because you don't need to sell this much to keep the price trapped. And then they could buy it back on discount. You really give them the power to control the market, and I think that's what's kind of happening here.
Right.
You know, we can smell it. Those who are adept can see it happening. You know, and slowly this entire system is going to get, you know, absorbed into legacy. But what we have as a defense mechanism is Hex, right? Because it's the one thing that was originally fairly distributed, and for them to come in and get all of the Hex supply, you know, it's going to be up to the top like 4,000 Hex wallets to really hand it over at a higher and higher price. And I just don't think, you know, we're in a realm where that's in the short term. I think that's a long time away before, you know, the price of Hex is going to be $10+ by the time they would even have enough of the supply to affect that in that way, where like they could get, let's say 50, let's just say 10 billion, or like even just a billion, like a billion Hex to get that supply. The price of to get that amount of supply of Hex, it's going to push the price up so tremendously, astronomically high, and so many people are going to come in and be a part of that move. It's just not so cut and dry, and we have like the power of that origin address there with you know 80% of the supply that acts as like a safe haven to protect that yield, so that even if let's say a DCG or like or BlackRock comes in and gets a billion or 2 billion or 10 billion Hex, that they won't be able to stake it all and get all the yield and manipulate the market from that angle as well. So there's a lot of secret sauce to the Hex contract that's making it the safe haven play and store of value that just isn't seen and appreciated enough right now in crypto. But if this occurs with Bitcoin, people are going to have to look, and they're going to have to see that this might be that last bastion of hope. You know, we have 300,000 holders plus on 2 chains. We have 100,000 plus people getting yield, or wallets, I should say, with maybe some duplicate people in there. So we have that core foundation. You have hundreds of people who like to talk about it and stream about it, thousands probably by this point. So it's comforting knowing that we have that as an option in the event that this does occur with Bitcoin.
And this is just, again, just to put a kind of a bow on it, this is one of those aspects of decentralization that matters in general, and that if you just have big entities, people will come break them, right? So like if you, it's a little hard for me to read from where I'm sitting back on the screen, but if you look at like, I don't know, like the fourth one down, it's a couple thousand, right? So
21,000.
Yeah, let's look at we'll take the Galaxy Bitcoin Fund, right?
Oops.
So those guys have got a few you know, the particulars aren't too important. So those guys have got 3,200, right? 96 million. Okay, that's a big pile of money, don't get me wrong. But the more when you put these things in a single place, you raise the incentive to come break stuff, right? So what happens is when you have, you know, $19 billion sitting somewhere, when you have these massive incentive models to come break things, you raise the threshold of people who are willing to do so, right? So like, why do bridges get attacked in crypto? That's where all the money is. How come people are going to want to come break Grayscale? That's where all the money is. You know, you see this in general, right? So not only is DeFi sort of a censorship resistant model, but the more dispersed it is, like you have like this functions and all those kind of things. Like you see this like laws of power, like not to isolate yourself. Like you see this is like a physical force about like isolation and centralization. It makes things efficient, but it also like it increases the attack surface, right? So the things that I'd be willing to do as a participant to come break Grayscale or capture the Grayscale trust is literally 20 or 30 or 40 or 100 times what I'd be willing to do to go get the Galaxy Bitcoin Fund. So it like these things start to have like you start to look at it not even as a Bitcoin problem, but hey, how can I break this trust? And like trusts aren't on chain, and they have different incentive models, and they have legacy issues, and they've got boards of directors, and a guy named Barry Gilbert who's got his feet to the fire, and the Winklevoss boys are, you know, now suing them. That's not on chain, And it's because the Bitcoin is now held in a trust. So now there's a trust issue, like a trust, like a financial vehicle that has added a attack surface here. And like, this is where DeFi plays its role, right? Like, it's not just, hey, we can move these things around. It's not just like a narrative drum we beat. Like, you can see here where a lack of DeFi, where there's too much consolidation and something like Grayscale is starting to like jeopardize some aspects. Now, again, this can sound like doom and gloom. Again, we're kind of talking some worst case scenarios and working through, again, some of the pros of something like Hex, where the OA kind of works as like a nuclear deterrent. You'll never see it because people just won't do it because it'll push the button, right? So like this is some of those other aspects of DeFi and why they're so important. Like we don't even think about this aspect very often, but when you see it exacerbated and you can see that big ass number on the screen, it's like, oh yeah, that's why we use DeFi. That's why we use multiple wallets, multiple exchanges. Like you see this stuff scale all the way across.
100%. Super cool. Man, we could probably talk for ages. Is there anything else you want to talk about before we'll go another 15 minutes or so? What are we, an hour and a half?
One, just thanks again, man. This is the most fun I've had looking at charts, and I don't even know how long. So I'm glad we got a chance to link up and talk through some cool stuff. Man, I mean, I'm excited about our stuff here. We have, I think what again, I think part of my incentive to try to get to some of these things with LL, and I'm gonna start, as we're getting close now, I'm gonna start retouching on a few different things about like actual use case, like how to use these things as a tool. And I think that we should see that in Hex as well, and with Pulse Chain, that there's more to do than just like buy and sell these things. Now,
yeah, dude. With that, you know, even for like me personally, so my personal approach to this whole problem is education. So,
yeah,
you know, the most important thing is teaching people how to use DeFi. Like, if without that, we're back to where we started, where people give away their power. So you need to teach people that they have power in DeFi, and you need to teach them how to use it and wield it properly. You know, so just some of the stuff I've been working on has been like, you know, teaching people about liquidity and on-chain liquidity providing, how market makers think, the psychology of how a market maker thinks, the psychology of how a trader thinks, so we can educate our market to be more intelligent about how it approaches its actions and how it affects the chart, how it affects people. Like, because there's really people behind these systems, right? You know, if somebody comes in with, this is just a bash on this person who did this, but so somebody comes in with, let's say, 30 or 40 grand in January 5th, 2020 on Hex, and then you know, and then at the top ends up selling, let's say, $12 million. You know, I think this kind of occurred, you know, in a roundabout way in Hex. Are they thinking about the long term or the midterm implications of that, and in terms of who are they hurting? Not so that you shouldn't be allowed to sell your stuff, your keys, your cheese, as Dibcatcher likes to say, obviously. But you know, are you potentially giving your coins? First of all, are you hurting somebody who needs like the funds to live life? Are you, or on another token, are you giving away the keys to the spaceship to somebody who can come along and try to manipulate the supply for another 2 years or another 4 years? And I think we're early enough in the cycle that a lot of that stuff's not really a threat because of how small it is. It's the right amount of size of a big enough community with a strong enough conviction in the product, and not enough people globally in it yet, that we're at that sweet spot where those people that are taking action now and absorbing the supply at these levels and believing it long term are going to just be rewarded so handsomely for their participation in this financial takeover, where true DeFi gets a chance to live on and make the world great again.
And like, that's a perfect example is, so what we've basically seen is it sloshes into crypto and it sloshes right back out, and it sloshes in and it sloshes back out. So like, and that's where I think that narrative, like, hey, this isn't going to zero anymore. There's more tools, there's more things to do. So like, if you're okay, let's just say that guy's going to cash out 12 million and do what? Like, you're just going to snort it up in Vegas, go buy the Lambo, and then what? Like, you're going to blow through it and then go get a job, or what are you doing? Right? You're just going to hold on to it, hope that you don't burn through it before another cycle. Maybe this is the last cycle that happens, right? You're going to put it in commercial real estate. Well, commercial real estate could be down 80% too. So I think part of this whole narrative, on top of just make your gains, crypto, kind of all the narratives we really understand, is it doesn't have to leave anymore. but there are actual tools to keep using this stuff. There are ways to do yield. Like this stuff isn't just narrative memes anymore, right? Like you can actually keep this stuff here. You can build a portfolio that will last through the bear cycles. It's not going to zero, and you can move these things around. So if you do want to be free and move and add these other aspects around and be able to cash things out, there's more and more ways to take crypto and spend it almost more directly, where you don't have to cash out the whole bag, drop it all and chase. There's more places that will allow you to basically go directly in some ways from cash, directly into other services. There's more tools to like keep this value around, right? So a lot of times we tend to see that we take $12 million and then we go back to legacy so that we can do legacy things. Legacy type instruments are here now. You can rather than a treasury bond, you can stretch it out with Hex. Rather than taking it and using something like borrowing in different lending projects and products on real estate, you can do that in LL, right? Keep that collateral on chain. And so as we broaden these things around, go make $12 million. Do not get me wrong. That is what you should absolutely go do. But it doesn't need to slosh back into fiat trash, and that you hope that the Fed now and all these other issues that we talk about, like that real DeFi that we talk about, like if you had 12 million, do you want it in dollars or you want it in crypto somewhere? You want to be able to move it around. If somebody really comes and wants to put a mask on you, tell you what your money can do, tell you what to say, tell you where to go, do you want to be able to go, you know what, I'm good, and walk away with all your funds? Or you want them to go, hold on, you have to play nice. When you act nice again, we'll let you have your money back. Which one do you really want? So like this stuff, again, some of this stuff is not a narrative anymore. So having more tools allows you to keep the stuff in crypto and use it for what we kept saying it was always supposed to be, which was financial freedom. And financial freedom doesn't mean you just don't go to a job. It's more than just that. So being able to have these things and these utilities around, being able to keep it in crypto is valuable on its own, right? Again, like even the WEF, BlackRock, all these guys are starting to get the game, right? So this stuff matters. Like
and I think to defend like some of the guys that are thinking of it in this way, so I'll key off of what Corey, Geary, and Dane like to talk about, which is like they want to use crypto as a wealth creation tool, and then they want to bring it back into real estate as a wealth preservation tool. And I like that theory for like if you're thinking one cycle ahead, but why wouldn't you be thinking like 3 cycles ahead? Think about this with me for a second. So that's all good and dandy, but then you're back into legacy. You have all these tax implications. You have to, you have mortgages, you have people to pay, all this stuff. Like, are you going to be living in these, let's say you're doing like a many units of apartment complex or something, or like a commercial real estate or something. That comes with so much headache and overhead. If it's not the house you're living in for your own benefit, and now you go out 2 to 3 cycles, like at what point is enough yield enough? Like let's imagine a world where Hex goes to prices where your monthly yield is paying you more than your 20 unit. Like, well, that is going to be a reality for those that wait out for the long game. And I envy the people that are 18, 19, and 20 now that are, they did well on the first Hex cycle and they still have all these years of life ahead of them where they can really harness the power of 15-year Hex stakes coming out every single year perpetually forever and getting that insane yield. People are missing the opportunity there, and what these things are going to be paying long term is going to greatly outweigh anything that you'll be able to do in terms of wealth preservation in the real world. And it's being missed. It's almost like unbelievable because there is still a conversation of EHEX can go to zero. That is opportunity staring at you in the face, telling you that people do not understand this and that the market is mispricing the asset and doesn't understand where it will be in 15 to 20 years.
So you want to do real estate? Why don't you take a 0 interest, no repayment schedule, post collateral back loan, or you could go pay 6% in the mortgage? Which of those sounds more attractive?
Dude, liquid loans really opens the door for full domination of the real world through DeFi. It really does. It protects you in every angle. And we don't have enough time to dive into all that, but like listen to this guy talk because he's out there been trying to spread the word about like what you can do with this stuff long term. Even in the short term, like pretty soon you'll be able to take a loan against your own crypto, and that has different tax incentives for doing that, right? And that has different outcomes. And if it's over collateralized in the way, this is where education is important to strategize around how to do this safely and effectively to hedge against 99% drops in asset prices inside of crypto. But if you're big enough in the space, you can still borrow enough from yourself to compound those returns back in the real world. So anyways, there's just so much strategic things, approaches to this DeFi system that we're setting up. And this is the first time one engine has ever came online all at once and had the backing of this core unit in Hex, right? So I'm super excited by how this is all going to go about, and it's beyond my comprehension of all of the outcomes that can happen.
Yeah, man. Yeah, I think it was a great stream. This is exactly what I was hoping for. It was a blast to talk. We'll have to do it again soon.
100%, man. Thank you so much for your time, and we'll catch you guys all in the next one. All right. Peace.
Cheers, y'all.